Howdy, y'all. Welcome back. It's the Liberty Call for Thursday, February 24th, 2022. Hope everybody's having a fantastic day out there. Got a little war on the horizon, evidently, with Russia-Ukraine. I'm frankly a little surprised that Vlad is aggressive as he's being right now. But hey, I'm an investment analyst. I'm not a war strategist, but we'll see where things go. Hopefully, things calm down here in the upcoming days, but time will tell. As far as the markets, it was kind of a back and forth day. The futures overnight were up, and then by this morning they were way down. The market opened way down, and then came roaring back. And then commodities, which were real high throughout the first half of the day, fell. So just been kind of one of those whipsaw days in the market. All right. Well, let's take a look and see how things turned out for the day. The Dow Jones was up 0.28, closing at 33,223. S&P 500 was up 1.5%, closing at 4,288. NASDAQ was up 3.34%. It just, when it took off this afternoon, boy, it was on a rampage. It closed up at 13,473. Small caps are also up 2.5%. The VIX receded 2.26%, down to 30.32. Again, it's still above 30, so that is still kind of that danger zone we need to worry about. But it's good to see it heading back down, at least for today. As far as markets, let's see here. Mexico had an up market, but everything else across Western Europe was down 2 or 3%, some 4%. Let's see, one green here in Denmark. Russian markets were down, 33%, 39%. Massively down in those two markets right there. What is this? This is Poland. They were down 10%. Turkey down 8%. So it looks like Eastern Europe got crushed along with the Russian markets. That's not really to be surprised since Russia right now is the aggressor in the situation. It's not surprising at all to see their markets tank. But by a third, that's pretty big. And across the Asian markets, mostly down, 2-3%. But looks like they were probably second worst. Eastern Europe was the worst. And then for some reason, we came out with a positive day. So we'll see what tomorrow brings us. And we'll have a better idea going into next week where things are headed. So let me bring up my chart and I can show you here. This is gold today. You can see where went up close to around 1970-ish. Looks like it got up to around 1971 an ounce. And then in the course of, just a couple of hours, dropped down to about 1880. So that's about just under a 4% drop just in a couple of hours. And then it rebounded up above 1900. So kind of a whipsaw day in the gold markets. Let's see, silver, very similar chart. And let's go over to the Dow Jones. It's kind of the opposite. It started out, terrible. See how far down that was. How many points? About 700-800 points from yesterday's close. And then we wind up finishing in the positive by about 54 points. So kind of a weird day. Equities were pretty much in the crapper all day until about 2 o'clock Eastern, and then the last 2 hours of the trading day made a nice rally. The Nasdaq started out down about 2.5%. Quickly made that back up by about noon on the East Coast, and then finished up for the day. Let's see. What was that? About 3%. So again, certainly, kind of a back and forth wild day in the markets, but, again, these things happen. So, all right. Got a few articles here I want to breeze through. The first one, Biden unveils more sanctions on Russia to further cripple the economy, written by Yassine Ibrahim from investing.com. Let's jump into this. U.S. President Joe Biden announced Thursday wider sanctions aimed to further cripple Russia's economy and assess to key technology imports after Russian President Vladimir Putin initiated a full-scale military invasion on Ukraine. Today, I'm authorizing, this is quotes, today I'm authorizing additional strong sanctions and new limitations on what can be exported to Russia, Biden said. This is going to impose severe costs on the Russian economy, both immediate and over time. Putin announced a special military operation to denazification Ukraine. Not quite sure what that means. The order to invade Ukraine comes as efforts to find diplomatic solution to de-escalate tensions ran out of road. The sanctions will block 4 more major banks, including the VTB, freezing Russia's assets in America, and also restrict Russia's ability to import key technology needed to upgrade their military industrial capacity. Quote, as we squeeze Russians' access to finances and technology for strategic sectors of its economy can degrade its industrial capacity for years to come. We estimate the sanctions will cut off more than half of Russia's high-tech imports, limiting their ability to continue to modernize their military, Biden added. Biden also said the U.S. was prepared to respond in kind to any cyber attacks from Russia on U.S. companies. Earlier this week, the U.S. announced the first tranche of sanctions aimed at 2 Russian banks and elite individuals who were backing the Kremlin's invasion of Ukraine. Biden followed up those measures with sanctions on Nord Stream 2 and the company tasked with building Russia's Nord Stream 2 gas pipeline. The sanctions are expected to take time to have the desired impact, Biden added. As the waiting game on impact of sanctions unfolds, geopolitical tensions will remain elevated and may prove the final headwind that tips the broader over the edge into tips the broader markets over the edge into bear market territory. Somebody's missing some words there. I don't see how we can get a resolution on the Russia-Ukraine crisis because the sanctions are likely to stay in place unless Russia withdraws from Ukraine. We don't expect that to happen, Philip Toews, CEO and portfolio manager at Toews Asset Management, told investing.com on Thursday. I think this may be the last ingredient we need to see a full-blown bear market in broader U.S. and U.S. indices and international markets. So if he's correct, this could tip us into a bear market, potentially a recession. So it's too early to say. I mean, is this really going to have a long-term effect on business in the United States? I don't really see it, but could it just have some negative effects from a perspective or the emotions of the market? Certainly. I mean, markets are very emotional. People don't just invest on straight facts and data. A lot of times they'll trade based upon how they feel about where things are going. All right. Next one, gold crosses 1975, then tumbles as some geopolitical froth blows off. And we did look at the chart a little while ago. This is from Bharani Krishnan. Gold hit a 13-month highs above 1975 an ounce on Thursday, but its rally may have also hit a ceiling as the West's response to Russia's invasion of Ukraine appeared to contain some of the geopolitical risks that sent the yellow metal soaring. Gold's most active contract on New York's COMEX April settled up $15.90 or 0.8% at 1926 an ounce after surging to a January 21 high of 19 or surging past a January 21 high of 1976. But in after-hours trading, it surrendered all those gains, sliding more than $18 on the day, or almost spent. Gold sank as U.S. bond yields jumped as the 10-year Treasury note went from 1.846% low of the day to a high of 1.975, with investors rediscovering their risk appetite. We already talked about the NASDAQ. Let's see here. Anything else? Yeah, that's basically it there. So I would expect gold to continue on its trend over, as long as the inflation is still an issue. I would expect gold to continue its strong trend it's been on the last few months. All right, some good news here. U.S. labor market recovery gaining steam. Unemployment rolls smallest in 52 years. It's written by Lucia Mutikani. All right, jump in here. The number of Americans filing new claims for unemployment benefits fell slightly more than expected last week, indicating that the labor market recovery was gaining traction. The weekly jobless claims report from the Labor Department on Thursday also showed unemployment rolls shrinking to levels last seen in 1970. underscoring the tightening labor market conditions. This is an acute shortage of workers with a near record number of job openings, keeping layoffs minimal. Beyond weekly moves, we see the downtrend in filings persisting as virus-related disruptions continue to dissipate and businesses return to more normal operations, said Rubilia Faruqi, chief U.S. economist at High Frequency Economics in White Plains, New York. Overall, strong demand for labor amid labor shortages suggests layoffs will remain low. Initial claims for state unemployment benefits decreased 17,000 to a seasonally adjusted 232,000 for the week ending February 19th. That almost reversed the prior week's surge, which economists had blamed on week-to-week volatility in the data and the delayed impacts of winter storms early in the month. Economists polled by Reuters had forecast 235 applications for the latest week. Unadjusted claims tumbled 24,824 to 214,873 last week, led by a sharp decline in Missouri. There were also significant decreases in New York, Ohio, Tennessee, Florida, and New Jersey, offsetting large increase in Michigan. With 10.9 million job openings at the end of December, claims are likely to fall back below 200,000 in the coming weeks. They were last below this level in early December. Many Federal Reserve officials view labor market conditions as already at or very close to maximum employment. The U.S. Central Bank is expecting to start raising interest rates in March to tamp down inflation. Yeah, we know all about that. So, all right. So that is some good news from the labor market, and we'll see if that does continue to trend in a good direction. All right. And then one last article here. This has to do with Jeremy Grantham, who is a investor economist, kind of a all-around smart guy. This article is titled "4 ETFs to Weather Jeremy Grantham's Prediction of a Superbubble Pop That Wipes Out $35 trillion of Wealth," according to the CEO of an investment firm. He also shared his practical approach to investing with an inflationary environment. Right. Legendary investor Jeremy Grantham has said the U.S. is in the fourth superbubble of the last 100 years. The first three he identified preceded the crash of 29, the Japanese crisis of 89, the 2000 dot-com collapse. Grantham, who is well known for predicting the 89 and 2000 episodes, as well as the 2008 financial crisis, now says the forthcoming bubble pop could wipe out $35 trillion of wealth. He expects it to send the S&P 500 to 2,500, which is 48% of its record high. What makes this bubble unique and more dangerous is that it extends beyond equities and into housing, bonds, and commodities, every major asset class. This scenario, shaped in part by historically low interest rates, is only comparable to Japan's stock and real estate bubble that popped in the early 1990s. He wrote in a note posted by his asset management firm, GMO. This time last year, it looked like we might have a standard bubble with resulting standard pain for the economy, Grantham said. But during the year, the bubble advanced to the category of super bubble, one of only three in modern times in the U.S. or in U.S. equities, and the potential pain has increased accordingly. Final stage indicators of super bubbles include price acceleration at 2 to 3 times the average speed of a full bull market, persistent underperformance of speculative stocks, and crazy investor behavior seen recently in meme stocks, EV-related stocks, and digital assets such as cryptos and NFTs. What Grantham's forecast means for the average investor. Grantham's prediction is certainly plausible, says Brian Cannon, CEO and chief portfolio strategist at Cannon Advisors. In technical analysis, it reflects the Elliott wave theory or grand supercycles, which observes repetitive market behaviors and may flow over hundreds of years, he noted. This long time frame is useful to keep in mind, but is not very practical from a trading perspective, Cannon said. While he agrees there are many classic signs of a late cycle behavior, including rising wages, inflation, and rising interest rates, trying to time the market isn't easy. It could be several years before Grantham's predictions play out, he said. And for the average investor, it's difficult to make any specific portfolio adjustments or trading maneuvers based on that forecast. I think it's prudent to follow some of Grantham's portfolio ideas to help dampen volatility, Cannon said. He spoke of looking globally and not being so U.S.-centric in our investing, avoiding speculative positions, and keeping the quality of high on your equity. That doesn't make sense. Keeping the quality high on your equities, focused on more low-price stocks and not chasing stocks. That's always good advice. Grantham also mentioned his preference for raising some cash. I think that's fine if you're going to put that cash back to work at a lower rate. Otherwise, it was all for none. Many people are not going to get it right, and Kanan thinks that's where the damage will be done. His advice is to take a simpler approach. First, for an average investor, you're not into stock picking, then lean your portfolio on exchange traded funds and indexes focused on value stocks. Check. I did that last fall. Second, considering emerging markets that are heavily in commodities such as oil and gas. Countries like Brazil, Indonesia, Philippines, Saudi Arabia, and Qatar are global markets that fit that scenario. I increased commodities last fall again, or actually last summer. Third, avoid speculative and growth-based stocks because as inflation rises, it's harder for these companies to continue to grow as their previous rates, Kanan said. This is another reason to look outside the U.S. because the S&P 500 and NASDAQ are heavily weighted towards tech and growth, which tend to lag in a rising interest rate environment. Kanan noted developing countries tend to have underweight of tech and are more weighted towards energy, materials, commodities, which hold up much better against the backdrop of inflation. Fourth, keep in mind crypto is a very speculative investment with lots of big moves that can create lots of wealth, but by the same token, erase it very rapidly. He admits that in reality, the asset class is here to stay, but it's too early to determine whether it's an alternative to stocks or a hedge for inflation. So, I didn't have that on the screen. I apologize. So that was the article. It's attached in the notes if you want to read through it. So basically, a lot of the same things I've already been talking about here from a positioning perspective, moving from growth to value, increasing your exposure to energy and things that people use. Your stocks, your energy stocks, your energy companies, things like that. Also, switching over or moving a greater percentage into international stocks and your growing stocks in the international market. So it's it's just some slight changes that can pay some big dividends later. Also, Mr. Grantham talks about the S&P 500 dropping almost 50%, which it did in the 08-09 crisis. We saw about a 50% drop. I was expecting that this last time 2 years ago. So we'll see once we fully go through the cycle what will eventually happen. But stay positive. Get out and do some fun things. Don't let the markets or what's going on in the world get you down. Ukraine and Russia is on the other side of the world. And last I checked, we don't share a border with them. And I think in the end, things will work out. Now, again, I'm an optimist. It could go completely the other way and we could have a full blown out war. Certainly hoping that it doesn't go that way. Certainly our young men are not worth dying over for a border dispute or a land dispute on the other side of the world. So, all right. Well, hope everyone has a wonderful evening, and I'll be back tomorrow with the weekly wrap up. Hopefully, the world calms down a little bit over the next 24 hours. If not, hey, I'll be here to talk about it and look for the bright side of things. So, hope everybody has a great night, and I'll be back tomorrow. Bye bye.